Trading with this strategy is like flying a plane. On most days, the skies are clear, the weather is fine, and the controls work flawlessly. You just sit back, relax, and smoothly reach your destination, almost without effort. In trading terms, that's when our strategy consistently makes profits during normal market conditions. Most of the time, we have normal conditions, and this strategy works like a money printing machine in this environment. But sometimes, weather conditions can suddenly change, and turbulence can arise without much warning. That's when the pilot needs to be more careful. Similarly, as traders, we occasionally face challenging market conditions or unexpected events. In these moments, we must be prepared and know exactly what to do to safely navigate through without putting our account at risk. Here, I have 4 recommendations for you to recognize this turbulence in advance so you can avoid it, or if you're already caught in the turbulence, how to handle the situation to land safely, protecting your account and your long-term success. The first recommendation is don't trade when the ATR is less than 5 pips or more than 30 pips. Let me explain the logic behind this. If the ATR is too low, below 5 pips, it's generally not a good moment to enter trades because your positions will have very tight take profits and limit orders. If volatility suddenly increases later and the market moves against you, your limit orders will quickly get triggered and you'll have limited room for managing your trades effectively. This situation can escalate risk dramatically. Similarly, if the ATR is excessively high, above 30 pips, your trades will have wide take profits and wide limit orders. If volatility decreases afterwards, you're left with the price making small movements while you have very distant take profits and limit orders. Your trades might remain open for much longer than intended, possibly going overnight or over the weekend, which we prefer to avoid. Now, while it's very rare for currency pairs to go above 30 pips with the ATR on the 5-minute time frame, it's actually quite common for certain currency pairs to have the ATR below 5 pips. In fact, for some low volatility pairs like Australian dollar, New Zealand dollar, or Euro pound, it's rare to see the ATR above 5 pips. This goes back to previous advice I gave you. Become familiar and comfortable with the currency pairs you trade. If you know a currency pair well and you understand that it typically stays below 5 pips on the ATR and even during high volatility events doesn't make strong movements, then it's fine to take the trades with the ATR below 5 pips. My recommendation on the ATR range is primarily intended for beginners to help them avoid situations that could easily become dangerous. However, if you are experienced and confident in managing these conditions on certain currency pairs, then you can safely take trades outside these ATR ranges. If you're still gaining experience, I strongly recommend sticking to the guideline of avoiding trades when the ATR is below 5 pips or above 30 pips. My second recommendation is to avoid trading right before important news and data releases. High-impact news or data releases can dramatically alter market volatility and temporarily skew ATR readings. So if you enter a trade before important news, the risk is that you will have several limit orders triggered in a matter of minutes or sometimes even seconds. If you enter right after important news, the risk is that the ATR may be unusually high, setting take profits and limit orders very far from their typical ranges. Once volatility returns to normal, you might be stuck with distant take profits and limit orders, which increases the risk of carrying trades overnight or through the weekend. So my recommendation is to avoid opening new positions at least 30 minutes before and after important economic events. Of course, this applies to opening new positions, so you should still manage existing positions as usual during these periods. Now, where can you find important news and data releases? I recommend using forexfactory.com. It has a great economic calendar with important data releases marked in red. Additionally, it has a news section which also uses color coding to indicate the importance of each event, again with red being the color for important news that can affect the market. You will find the link to Forex Factory in the resources for this lecture. My third recommendation is to stay away from unusual market conditions. Occasionally, the market experiences unusual events, such as geopolitical shocks, political statements, or flash crashes, and more. Among the most significant and fast ones I remember in my career as a trader, there are the Japanese tsunami in March 2011, with US dollar Japanese yen dropping more than 400 pips within minutes, the Euro Swiss franc crash in January 2015, down more than 2,000 pips in a few minutes, the Brexit referendum in June 2016, with pound dollar down about 1,600 pips in less than a day, the pound flash crash in October 2016, with pound against US dollar dropping more than 900 pips in a few minutes due to algorithmic trading combined with low liquidity, the Japanese yen flash crash in January 2019, with Australian dollar Japanese yen dropping over 500 pips in a few minutes, and more recently, in April 2025, the trade war between US and China, which caused some currency pairs to drop more than 300 pips in less than a day. I want to talk about each of these events individually. The first one, the Japanese tsunami in March 2011, was a tragedy beyond trading. It was entirely unexpected, no one could have predicted that, so no one could really protect their trading account beforehand. But let's consider some facts. At the moment it happened, the RSI was not giving any signal, so you wouldn't have had any trades. Even if you did, the ADR was 4.2 pips, so it would have been below our recommended 5 pip threshold. And even if you had entered the trade, with a conservative lot sizing of 0.02 lots per $5,000, you would have reached a drawdown of less than 40%, recovering completely by the next day. The main point here is nothing could be done to predict or prevent these events, but our risk management guidelines could have prevented you from taking any trades, while in case you had entered the market, our conservative lot sizing rules would have significantly limited the damage. Let's talk about the Euro Swiss franc crash in January 2015. From 2011 to January 2015, the Swiss National Bank, the SNB, had artificially maintained the value between Swiss franc and euro. They kept the price of Euro Swiss franc at or above 1.2, meaning the Swiss franc could not become too strong against the euro. The SNB did this because if the Swiss franc became too strong, it would hurt Swiss exports. In those years, you could see Euro Swiss franc moving only about 5 to 10 pips a day, no more than that. The ATR sometimes was even below 1 pip. On January the 15th, 2015, the SNB suddenly announced they will no longer defend this so-called peg. They removed the floor of 1.2 and the price immediately started to go down after this announcement. It took more than 2,000 pips in a few minutes, spread was over 100 pips, stop losses wouldn't hold. It was the most dramatic event I remember in the Forex world. Some brokers went bankrupt, many traders lost a lot of money. A friend of mine and colleague from the trading industry who had moved to Thailand to trade full-time and enjoy a more affordable lifestyle lost his entire six-figure account that day only because of the Euro-Swiss franc crash. Could you stay away from all of this? Absolutely yes. First, with the pair moving only a few pips per day, we would never have opened any position on Euro Swiss franc. Second, every expert trader who followed the Euro Swiss franc knew that the moment the Swiss National Bank decided not to support the exchange at 1.2 anymore, volatility would have skyrocketed. We would never have fallen victim to this crash. The next event is the Brexit referendum in June 2016. Not much to say about this. It was a scheduled event, and everyone expected extreme volatility on the day of the referendum. Avoiding this risky scenario was quite straightforward by simply not trading pound pairs around the referendum date. Regarding the pound flash crash, this could have been avoided in many different ways. Firstly, it happened immediately after the end of the New York session, a period we've clearly learned to avoid trading due to unfavorable market conditions, such as low liquidity, which was the main cause of this crash. Additionally, when the RSI signal to buy was generated, you could tell something fishy was already going on, because volatility was already much higher than usual, and pound against US dollar was already down more than 100 pips for the day. In case you took the trade anyway with a conservative lot sizing of 0.02 lots per every $5,000, that would have been dramatic, because with an ATR of 14 pips, the whole movement of more than 900 pips would have just been enough to wipe out your entire account, before reversing and going all the way back minutes later. That would have been heartbreaking, to see your account gone just for the price to hit all your previous take profits minute after you lost your account. The next event is the Japanese yen flash crash in January 2019. Once again, this could have been easily avoided, because it happened right after the end of the New York session. Most flash crashes happen after the end of the New York session, when liquidity is much lower than usual. This reinforces the recommendations in the lecture about when to trade. In any case, even if you took the trade here, the whole movement wouldn't have been enough to wipe out your entire account if you had entered with a conservative lot sizing. The last event is the trade war between US and China in April 2025. It was well known that Trump announced tariffs in early 2025 and that China planned to respond. So volatility spikes were definitely expected, even though nobody could predict the exact day. As a good risk manager, you could have taken precautions like cutting your lot size in half or simply avoiding US dollar currency pairs altogether. But even if you didn't, a 300 pip move wouldn't have wiped out even half of your account if you were using a conservative lot sizing approach. So sometimes staying away from unusual market conditions only requires common sense, like avoiding trades right after the New York session closes. Other times, it demands a more active approach, like staying informed about potential threats that can suddenly increase volatility and put our trades in danger. With the account I have shared before, you can see I reached a drawdown of 75% during the 2 days when Trump announced tariffs against Europe and China. I had 2 positions in the Forex market and 1 position on the Nasdaq index, which I was testing with the strategy. In total, I lost over 600 pips in less than half a day, and I was also using an aggressive lot sizing approach. I barely survived and I ended up with a drawdown of 75%. Now, on my main account, I have a very conservative approach. I followed my own advice and closed all positions immediately after the announcement. With this smaller account, I decided to take a riskier approach, which was obviously a mistake, and I'm here to share it with you so that you can avoid making the same mistakes. If only I had stuck to my own recommendation of avoiding unusual market conditions here on this account as well, I could have avoided significant losses and likely ended my trading journey with results closer to plus 1000%. This highlights how crucial it is to be a good and solid risk manager with this strategy. This brings us to my last piece of advice for this lecture. Know when it is time to play safe. Sometimes, even without any apparent reason, a position can move significantly against you, leaving you with more than 10 trades open. Even with cautious lot sizing, having 10 or more trades open usually means the market is not behaving as expected. Now, with 10 trades open, chances are that your account isn't in real danger. Maybe your drawdown hasn't even reached the 2% yet. But effective risk management is about avoiding danger before it materializes, not after. So this is what I personally do. When I have more than 10 trades open, I try to be more conservative and always ask myself, how can I reduce the risk? Now, everyone can come up with their own idea on how to reduce the risk, and frankly, it also depends very much on the specific situation you are in, so it's hard to give a generic rule here. But through the years, I have found myself applying one practical method more than others when it comes to reducing risk. The method is close an additional trade manually for every 2 take profits hit. So imagine we have 10 trades on the market. The price reverses and it hits the next 2 take profits we have. In this case, to reduce my risk even further, I also remove an additional trade, so I have 7 trades left and not 8. Then, if the price continues in my favor and hits another 2 take profits, I have 5 trades on the market, and I manually remove another trade, so I'm left with 4 trades open, and I have further reduced my risk. When I use this method and remove one trade manually, I always remove the best trade I have, as it works better with the rules of position management for this strategy. Applying this method means that sometimes we accept a small loss on some trades, but the key to this strategy is to avoid risk. In normal market conditions, as I mentioned, this strategy is a money printing machine. The key to achieving great results is to manage abnormal market conditions where the risk increases. So don't be afraid to cut some trades when the situation is getting more dangerous. Ultimately, there are no fixed rules for perfect risk management, but I hope the guidelines and recommendations shared in this section gave you a strong foundation to develop your own personalized risk management approach so that with experience you can become an excellent risk manager and achieve outstanding returns with this strategy.